Good morning to our audience and welcome back to Boutiques on Wednesdays. Property is most certainly a sector that's remained under pressure since COVID. And for global property, we've seen in the past how REITs can perform well when a rate hiking cycle are at an end. Are we there now? Who knows? On the home front, other than inflationary challenges, our economy is super sluggish and one struggled to see any significant recovery soon. But was there some recovery in property fundamentals, and what is the outlook in such an environment? Joining us today is some of the top local and global property fund managers to unpack exactly this and look at their current positioning on local and global property. With us online is Greg Rawlins from Reitway Global, and from Sesfikile Capital, we are joined by Anil Ramji and Naeem Tilly. Gentlemen, thank you so much for joining us this morning. It's really an honor to have you with us, and thank you for your valuable time. We're really appreciative of that, and we look forward to your views on the local and the global front. The Sesfikile team are going to start with their presentations. Naeem, I believe you're going to drive the presentations from your side, so you should be able to share your slides now if you can. Naeem will be followed by Anil, and then straight after that we'll go over to Greg. And as per usual, if you have any questions, please post it in the Q&A box, and we'll try to cover as much of those questions as we can after both presentations. Thanks, Tim.
Thanks, Eugene. I think you've highlighted most of the issues facing the listed property sector. I was definitely facing several headwinds, and included in that is probably load shedding, the main driver of some of the sluggishness within the listed property sector right now. I'm going to try to paint a little bit of a different picture, because I think listed property locally is well positioned for these challenges, and not just fundamentally speaking, but also from a valuation point of view. I think a lot of this is already priced in. Starting with the retail sector, and remember, retail accounts for about 60% of our sector. It's still the primary source of income for listed REITs. We've seen during COVID some pressure coming through from the large retail shopping center formats that you typically find within the L2D and Hyperop portfolio. But the non-urban and rural shopping centers performed quite well during that period. Within the last 6 months, we've seen a big reversal of that. The larger formats, the Canal Walks and Sandton Cities of this world, have recovered to well above 2019 levels. And we are starting to see that convert into rental growth. Rental reversions still remain a bit negative, but the outlook for the next sort of 12 to 18 months is definitely on the up. You can see that in the chart in the top left corner, that rent to sales ratio, which we like to use as a measure of the affordability of rental for these retailers. That has obviously peaked during COVID at 9.5% as sales slumped, but that has now come all the way back to 7.5% from a dual impact of rentals rebasing as well as turnover improving. But we highlighted the issues. We don't think we'll see the strong growth in retail sales that we have seen in the last 2 years. We highlighted inflation and interest rates being some of the issues there. But we think we'll still see positive real growth. Employment is starting to pick up slightly. Consumer confidence is still a bit weak, but we think that credit growth will also pick up slightly. And we're still in for a reasonably good outlook for retail. Now, obviously, there's going to be a lot of questions about how load shedding particularly impacts the retail sector. Just to highlight that diesel costs to a lot more than normal electricity from the grid, about 3 to 4 times more. But a lot of the REITs do recover most of it. When I say most, it varies from company to company, but on average, we're looking at about 65 to 70% of the diesel costs being recovered. So from an earnings point of view, we're not looking at a lot of headwinds or at least impact on the bottom line. But a retailer cannot continuously be paying this higher amount of costs on electricity together with other municipal costs like rates and taxes, water, and all the other increases that they are seeing. As a result, we think that rentals may start to taper off slightly should we see this high cost growth going forward. However, there is a little bit of a silver lining here in that what companies were expecting to spend on solar over the next 3 to 5 years have all of a sudden been brought forward. And the yields are still very attractive. We're looking at about 15% yields on solar. And when you start to account for the higher cost of electricity offset by the higher yields on solar, we are looking at potentially the bottom line for REITs actually not that much impacted. And also with solar means that the uptime for a lot of these companies, the actual retailers and office users will be quite high. Looking at office, and this gathers a lot of attention, and the headline often focus on the amount of supply and vacant space in the market, but it's only about 15% of our sector, as a lot of companies have disinvested from this sector and moved into logistics and residential and storage. Vacancies were high last year. It stayed about 16% from the start to the end of the year. But within the B grade sector or segment, we're finding that vacancies have actually dropped. And this is the type of space that you'd find ordinarily within a growth point or redefined portfolio. And we found vacancies, as I mentioned, down from 12.8 to 9.8%. Now, at those type of levels, you're still not going to see much rental growth. If we start dropping below that 8% vacancy, then potentially some rental growth will creep into the B grade segment. But A grade space is also quite high. And we are saying that we are at a point where things are starting to turn around, but we are not at a point where we're going to celebrate the victory yet. Demand is very much dependent on the economy and load shedding. We know the story, but on the supply side is very limited new supply. There's only 0.5% of new supply coming into the market, and this has been for the last 3 years. So if we get that economy going a little bit, vacancies could drop quite quickly and rentals could improve. But again, as I mentioned, we probably will see negative rental reversions for the foreseeable future. Just I'm going to take one step back. When I talk about rental reversions, on a typical lease book, you've got 60 to 70% of your leases, which contractually grow every year by 6 to 7%, roughly. And that only that 1/3 of that book, which is expiring, will be subject to rental reversion. So we're still seeing growth across rental income on average. Industrial, I'm not going to spend too much time on. It's a much better picture in that we've seen vacancies lower, actually at record low levels at about 2.5%. It hasn't converted into rental growth yet, but we are finding that because building costs have been so high, new developments are pushing rentals much higher as well. So in the last year, we found about 30 to 40% growth in building costs. And where previously, where rentals were sort of reaching a ceiling of about 65 Rand a square meter, a lot of the new developments are coming into the market at 75 to 85 Rand a square meter. And that naturally pushes up the rentals. So for most of the companies we speak into, we're looking at potentially positive growth within the next 12 to 18 months or slightly negative in a shorter term. Now, during COVID, the big issue was around about LTVs or the debt to assets ratio, just a measure of the balance sheet strength for these companies. And you can see in the right-hand side, they peaked at about 42% during COVID. It was quite a high level, but companies reacted quite positively. And remember, during COVID, we saw, and as you can see in the top left-hand corner, valuations actually fell on average about 12 to 13%. So if your asset values are falling, you'd find that your debt to assets level will naturally increase. But at the same time, companies disposed of assets, more than 13 billion Rand and very close to book value, and they retained income, and they continue to sell assets and retain income, and LTVs have fallen down. So despite that valuation write-down, balance sheets have actually improved significantly and will likely improve over the coming year. Over the last result season that we've seen, most valuations have been largely flat. So even though bond yields have pushed out, there's still transactional activity in the market to suggest that office valuations are roughly declining a little bit, whereas retail and industrial are a little bit up, which means on average, we're finding that valuations are holding their ground. Good demand still remains for industrial property, retail, assets in the Western Cape. We're talking before this call about the demand for, because of semigration and the shift towards Cape Town and the Western Cape, that has led to valuations of assets, and even in the commercial sector, actually holding up in good demand for from private owners and owner occupiers as well. So looking forward, and interest rates are obviously front of mind together with load shedding. How are companies positioned for higher interest rates? I'm just going to look at the second 3 bullet points there. And you can see that in the bottom left corner, about 77% of debt is fixed, which means they're not subject to interest rate fluctuations. And the term of the fixes, so when those lease derivatives or expiries, fixed terms expire, is about 2.5 years. So we do expect interest rates to increase across the lease book, where we're not ignoring the fact. However, it will probably be a much more slower impact onto the bottom line than a 1 or 2 year single hit to earnings. It will be gradual in nature. Having said that, the outlook for interest rates is starting to turn, especially over the last month. We've seen in the US how expectations are for interest rates to start to decline. Even locally, our FRA curve is starting to look towards the end of the 12-month period. So in a year from now, we are looking at potentially interest rates starting to taper off. And a lot of companies are saying there's no real need to rush to fix the interest rates in the current market, potentially float the interest rates for the time being. So in summary, what I'm trying to say is, yes, the interest rates, if they stay high, we will see some of the impact come through over a 2 to 4 year period on average. Whereas if rates start to come down next year, the impact is very short term. It won't be that material for many of the REITs. Central and Eastern Europe is a major part of our sector. It's about 26%. We've got large caps like Nappy Rockcastle and MES. And we are looking at a very different picture than South Africa. We've got strong economic growth, limited new supply of retail sales. Inflation is high, but we're still seeing positive growth in retail sales in real terms. And what we're finding, which is unique to Europe, or rather different from SA, is that leases are increase by not a fixed number, but by inflation. So it's indexed to inflation. And with inflation sitting at 8.5% by the end of last year, most companies are pushing through those type of increases to tenants. And tenants are able to accept it, having had a decade of low inflation for coming through, and hence not much increase in terms of rentals. So they are able to absorb those increasing costs, and that is going to flow through quite nicely to our companies like Nappy and MES. To look at valuation, and a point I brought up earlier, there is a lot of problems. We're not trying to run away from that, but we think that valuations have accounted for it adequately. So if you look at this chart, I'm looking at the yield of the sector. The yield currently is sitting at about 11.5%. And if you compare that, the spread to the 10-year bond, and this is on a historic basis at 11.5% forward-looking, we're pretty much in line with long-term historical averages. So we don't think that a sector is expensive from a yield point of view, and that's from pure cash flow. And if you look at the net asset value, remember a point I brought up earlier about how assets are being sold at book value, yet the listed sector is trading at a significant discount to book value. So it is a mismatch between what the listed sector is saying and what the transactional market is saying. The listed sector is trading at a 35% discount to net asset value, so 0.65, which means that, and this is well below where net asset value is currently, or even below standard deviation. And we think that with asset values likely to remain firm, this is a signal that the sector is quite cheap. And if you look at our IRR expectations, our total return expectations over the next different periods in time, over the next year, we're looking for about 15.5% upside. Now, it is quite an optimistic number. And if you just break it down, we're looking at about 9.6% coming from income. Now, we mentioned that the cash flow of the company is about 11.5%, but how much they distribute to shareholders is about 9.6%. It's still a good number. And what differentiates listed property from bonds is the growth. And I know the 3.8%, a lot of people look at it quite skeptically. We do expect low single digits from SA, but the point I brought up was about our offshore exposure. About half of the total listed property sector is made up of offshore, which includes the UK and the US and Australia. We're still looking for good growth to come through from those markets. And on average, we're looking for about 3.8%. It's quite a conservative estimate in our opinion, and it does include about a stage 4 load shedding over the next year. And we're looking for a little bit of re-rating in the sector, trading at quite big discounts to where they used to trade historically. I showed you that chart relative to net asset value. We think that the sector should comfortably give you 15.5%, even in a tough environment, because we think it's fully priced in, and the companies have adjusted to this higher or a more challenging environment as well. Yeah, I can pass over to Anil.
Thanks, Naeem. So there's a world of opportunity in the global REIT space, and global REITs give you a liquid, low-cost option to access global developed market real estate. So majority of the REITs are located in the US, around 66%, followed by Europe and Japan. But you also have access to UK, Canada, Singapore, Hong Kong, and Australia. But more importantly, the global space offers you a high degree of choice and specialization. So about 20 years ago, the global space was very similar to the South African market currently, where about 90% of the market cap was in the core sectors of office, retail, and industrial. Today, non-core sectors like apartments, data centers, single family make up about 50% of the total market cap and about 95% by the number of stocks. We have about 16 different sectors to choose from and the ability to invest in a certain sector in a certain location. So for example, if you wanted exposure to data centers in Singapore or apartments on the west coast of the US, you can find a REIT that focuses specifically on that property type, giving you that high degree of specialization. Our fund has about 1.2 billion rand under management and uses what we call the concentrated thematic approach to portfolio construction. So concentrated in that the fund holds about 60 stocks compared to the benchmark that has more than 350 opportunities. And thematic in that we research, we debate, we identify key themes that are happening globally, and we check those themes against real estate fundamentals with the ultimate objective to expose the portfolio towards sectors and stocks that we believe will be beneficiaries of those themes, and then to be underweight sectors and stocks that we think will be disrupted by those themes. And then finally, we are in the process of setting up a USD-based UCITS fund domiciled in Ireland. Next slide. So the benefit of having specialized opportunities to invest in compared to just diversified companies is that each sector has its own micro and macroeconomic drivers that influence performance, especially during different periods of the economic cycle. So for example, retails and hotels benefit from people having more money, which generally happens during economic expansions. And then as shown in the graph, during recessions, they underperform. But self-storage, manufactured homes, triple net lease sectors have all historically outperformed during recessionary periods. Again, because of their own individual characteristics and fundamentals. So there are opportunities to pick winners even during recessions. Next slide. So moving on to some of the themes that we think will be winners, starting off with industrial. So overall demand drivers are still intact. So these are e-commerce growth, onshoring, supply chain modernization. But for the first time in a very long time in the US, we expect supply to be consistently more than demand over the next 5 years. But it is important to note that this cycle starts with vacancy rates at a record low 3.4%. If every square foot of space that is currently built on a speculative basis in the US goes completely vacant, the vacancy rate only goes up to around 6.5%. And history suggests that as long as the vacancy rate is below 7%, the power lies in the hands of the landlord, and you'll continue to see rental growth. However, we've taken this into account, and we've shifted the portfolio towards last mile or infill logistics space where demand remains strong. And that's driven by the fact that e-commerce companies need to reduce delivery times just to remain competitive. And I know I do it when I'm shopping online. You know, you see the dreaded ships in 5 to 7 working days. I immediately go to another option to get me the product as soon as possible. And then on the supply side, you know, these locations are very high barrier to entry markets, and there's almost no supply risk, which leaves us more confident in this space. Next slide. So moving on to self-storage, a sector that outperforms in any market, is driven with what is called the 4 Ds of self-storage. So it's death, dislocation, divorce, and destruction. All of these drivers of demand are generally non-cyclical in nature. And when these life events happen, it's relatively cheap to store things in self-storage. So in the US, for example, it's about $100 per month for a 10-foot by 10-foot unit, which is roughly 3 meters by 3 meters. Even during recessions, when people are forced to downsize, they just put their items that they don't actually want to get rid of into storage. On the supply side, so looking at the top left graph, we prefer markets with lower levels of supply. So in the graph that shows the square feet of storage space per person. So in the US, there's 8 square feet of storage space per person. But in Canada, that number is 2.5 square feet. In Europe, it's below 1 square foot per person. And that's where we have focused our portfolio. I'm going to skip the next 2 slides, just I'm cognizant of time, till we go to the banking crisis. Next slide. So, you know, something that's been on everybody's mind and in the media, looking at the US banking crisis and how that could impact commercial real estate. So the entire US commercial real estate market is about $11 trillion with circa $4.5 trillion of outstanding debt. Now, banks only account for about 38% of the total debt, but small to medium banks make up about 70% of that number. So we think, you know, the major consequence of this crisis is that near-term refinancing will come at higher rates, definitely putting pressure on cash flows going forward, especially for sectors with weak fundamentals, like offices, which account, as you can see from the graph on the right there, which account for about 17% of all outstanding debt. So, you know, in conclusion, our view is that in this environment, REITs with stronger balance sheets pose less risk and will definitely outperform companies with weaker balance sheets. And then moving on to balance sheets, the next slide. So the current LTV for global REITs is around 32%. And if I make the comparison to just before the GFC, it was closer to 50%. And the weighted average term to maturity, which is basically how long you have fixed your funding for, is now around 5.9 years, which is longer than pre-GFC times as well. So some regions are in better position than others. We are very concerned about some stocks in Europe, but in general, the sector is in a much better space than just before the GFC. But what is fair to say is that given the increase in funding costs, values or asset values should come down. Next slide. So just quickly on valuations, the market's currently trading at a 24% discount to NAV compared to an average of a 10% discount, which means the market is expecting about a 10% drop in values. It might be worse for some sectors, better for others. What we have priced in over the next 12 to 24 months is that cap rates will go up anywhere between 40 and 200 basis points. 200 basis points for weaker sectors like the office, but storage on the lower end at about 40 basis point expansion. Multiples have also contracted significantly. For example, industrial and residential sectors are down around 8 turns from its highs. And relative to global equities, global property is screened cheaper as it's trading at the lower earnings multiple than it normally does on a relative basis. And then my last slide, our total return expectation. So, putting all of this together, global REITs currently trade at a 5% forward dividend yield, which we haven't seen in a very long time. We expect dividend growth of around 6% for 2023, which is conservative, which we think is conservative, given the low payout ratios of around 65%. And because of that low payout ratio, and we've seen this in Q4 results, is that companies are able to grow the dividend faster than their earnings. And therefore, we think that number of 6% is conservative. We've accounted for a slight derating of around 90 basis points and a year-end US 10-year bond of about 3.4%. This is a Bloomberg consensus number. And putting all of this together, we expect a total return of around 11.8% over the next 12 months, and then between 10 and 11% annually over the medium and the long term. I can just conclude quickly. It'll literally take me 5 seconds. So just to conclude, why Sesfikile? Next slide, Tilly. Singular focus, all we do is listed property. We remained owner managed, experience and depth. Commitment to cap is only on the local side. The global space is a $1.5 trillion market cap, so no cap there. And then lastly, a proven process that generates alpha. We can't guarantee that we'll always outperform, but what we can guarantee is the process will remain the same. Thank you.
Many thanks, Anil. Greg, if you are ready, you should be able to share from your side. Yeah, it's coming through fine.
Thank you. Perfect. Thank you, and thank you for the introduction, Eugene, and good morning to the delegates. I'll commence with an extract from an interview with the economist Dr. Nuriel Rubini that has been playing on Bloomberg for almost 6 months now. For those who do not know, Rubini is universally known as Dr. Doom for his negative economic calls. Making reference to him in a presentation like this comes with a degree of risk, as he made a positive reputation for himself by calling what ultimately became the global financial crisis in 2008. He subsequently continued to promote an even worse doom and gloom scenario, only for the markets and global GDP to recover until 2020. However, he's moderated his calls and regained a modicum of respect and credence again. So listen out then for his description of the current position and his suggestions on how to address rising rates in a high inflation environment.
So let me ask you basically the same question, but from a different perspective. What should investors do here? And this is something, this is something I've been thinking about recently. And one of our recent guests, Toby Nangle, came on the show. He was talking about the moves in the gilt market, basically saying you can't unburn toast. So once you have this extreme volatility, once interest rates start to reset higher, you can't kind of undo that. And all of that historic volatility, that anxiety for investors, it all weighs on them for years to come. And you potentially get a repricing of risk in general. Capital becomes more expensive. Asset prices start to deteriorate, as you just mentioned. So what can investors do here?
Well, usually investors have some variant of a 60-40 formula for their portfolio, 60 equity, 40 fixed income, long duration treasuries, or 7-30, or even risk parity a la Bridgewater is a variant of the same. But usually the price of bonds and price of equities are negatively correlated in normal times. Risk on, equity do well, bond don't do well. Risk off, bond do well, equity don't do well. Growth, equity do well, bond yields go up, price falls. Recession, bond yields fall, price goes up, price of equity falls. So you're naturally hedged. And a 60-40 or 70-30 portfolio has given you for the last few decades positive returns, normally, more so in good times, less so in bad times, but always. This year, for the first time in 30 years, you have lost money on your equity side and on your fixed income, because 60-40 is based on low inflation. But when inflation is rising, two things happen. Long-term interest rates go higher. That hurts equity because the discount factor for equity becomes higher. And we've seen the correction of equity. And growth stocks and tech stocks that are long duration hurt even more because they're long duration assets and more sensitive to interest rates. But you lost 25% on the S&P, but this year you have lost 25% on your long duration treasuries, because 10-year treasuries have gone up from 1.5 to 3.5, 4, and that increase in interest rates is a 25% fall in their price. So you lost money on equity and you lost money even on the safe asset. There was nowhere to hide. And if you went into cash, you lost because of inflation. So that's the problem when you have rising inflation, that 60-40 doesn't work. What's the solution is not cash that's been giving you zero nominal return, wiped out by 10% inflation. You have to go into assets that are a hedge against inflation. One of them is TIPS, they reprice when inflation is higher. The second one is very short duration treasuries, because as interest rates go higher, the price of them falls much less than the one of a 10-year or 30-year treasury. As interests are higher, you get higher return, even in expected inflation. That's one. Secondly, you might want to go into gold. Gold has not done very well in the last year, but once inflation expectations become unhinged, when the central banks are going to blink, and until now central banks have played tough, that's why gold has done poorly, because the real rates were going higher, then gold is going to outperform, like other precious metals, like probably many commodities. But the commodities are going to be hurt by the recession, so gold is actually less cyclical. 3, in the 70s, both equities and real estate did poorly, but equity did much worse than real estate. The P ratio for S&P was down to 8 in 1982. Because real estate is in fixed supply, you can often reprice the rents, and it's a good hedge against inflation, as long as monetary policy is not very tight. Of course, the REITs this year have done poorly because the Fed was hiking. But again, when the Fed is going to wimp out, I think that real estate is going to outperform equities because of the nature of being a fixed supply kind of asset, at least in the short run.
So
what does Rabini mean when he observes that central banks will become unhinged? Central banks will blink and central banks will wimp out. Well, what currently belies these views is 2 periods in central banking history when in the 1980s, Chairman Paul Volcker raised the US Fed funds rates to a historic 20% in order to eventually break the back of inflation. But he did not have to be too concerned about breaking the banking system. Then in 2008 and 2009, Chairman Ben Bernanke had to save the banks. But he did not have to be too concerned about inflation, which was around 2%, and there was even calls to pump in more stimulus, thereby raising inflation just a bit in order to stimulate growth. On the other hand, and today, Chairman Jerome Powell has to address both. He has to curb inflation, be careful, and save the banks at the same time, be even more careful. So he's walking a tightrope, and we've already seen 3 banks, US banks, wobble, get into trouble, and the demise of the iconic Credit Suisse. The central banks have already suggested, albeit gently, a slowdown in rate rises is possible, particularly in the Fed, but it is early days. However, it is my view that they have to blink and wimp out, else the global economies will become unhinged, which is another word for the economies on for a hard landing if the appropriate action is not taken. So get ready for more elevated inflation into 2024 is my call. What has this all got to do with REITs and general market conditions? Well, everything. Rising rates and inflation affects all asset classes, some more than the others, some more indiscriminately than the others. Here's a chart showing the research of REITs returns compared to the S&P going back to 1972. As you can see, in periods of moderate inflation and supported by what Rubini noted, is that REITs outperform general equities in periods of moderate inflation and more so in high inflation. As to whether you call that we are in a period of moderate or high inflation, I'll leave that to you. But just remember, we've gone through an extended period of 2% inflation. At the moment, the US is sitting at about 6%, and just last month, the UK marked 10.4%. Taking this further, what happens then when REITs, with REITs in rising bond yield environment? And here what this slide is depicting is the REIT performance during and after significant increases in the 10-year Treasury yield since 1992. As expected, general equities decreased, US stocks decreased, or basically remained flat, and REITs declined by an average of 1.51%. However, the moment there's an indication of a slowdown in rate increases, and I assure you the market is not going to wait for the Fed to say, right, we're going to pause. We are in a heavily sentiment-driven environment. Every data point, whether it is PPI, CPI, PCE, or some labor data, creates or results in a significant move in the markets, which means that fundamentals are being ignored at this point in time. At the moment, there's an indication of a slowdown or a pause. This is the historic performance, and again, supported by what Nori Rubini has pointed out, is that REITs outperform general equities once there has been a slowdown or a pause in interest rate rises. Let's take a look at now what the general picture is. Going back 25 years, and I purposely included 25 years, but in this chart to show that for the last 20 years, global property has actually outperformed global equities. And the reason is being the inclusion of a significant number of new sectors. It's quite simply, what is property? It's something that is tangible, immovable, and it generates revenue by a rental contract. But the additions of the likes of the towers, storage, healthcare, and data centers, for example, which have continued to deliver high growth that invariably beats inflation, has contributed to this particular performance. And really, this begs the question: if you have equities in your portfolio, why then don't you have an allocation of global property in your portfolio? Taking this further, this is a position now over the last 20 years, and we've inserted the mean going back for 20 years, and I'll draw your attention to the first red circle on the left-hand side. Like all other sectors, property was hit significantly in the 2008 global financial crisis. The recovery was relatively quick. But even more so, if we look in 2020, the second red circle, where we had the sentiment-driven decline, significant decline, but look how quickly global property recovered. So I want to focus then on the green circle, where we are at this point in time. To us, it's a significant undervaluation, and this is an opportunity not only for you to enter, but you should be actually increasing your exposure to global property. But let's have a look at this valuation disparity in a bit more detail. Here, going back for the last 10 years, the historic 10-year mean for the S&P is 19.1. As of Friday, 31st, that was the last week, it is still 3.1% above the 10-year mean. Whereas have a look at the property where we take the price of the funds from operations. Historic mean is 17.6. On Friday last, it was 14 dead on, which is a discount of 20.5%. So let's just take it to where we are at this point in time again. There we are. I am not suggesting that there's going to be an immediate rise to up to the mean again. However, with 28 sectors and subsectors, we are significantly overweight in the sectors that have got a strong propensity to increase, to deliver inflation-beating growth in their rentals and, of course, their net income and their free cash flow. So, to conclude, the uncertainty in global markets is currently at elevated levels. It is most likely going to persist well into 2024. Broadly speaking, when uncertainty is high, then diversify. And I'm well aware that many South Africans do not have global property in their portfolio. It's time now to not only increase your exposure to global property, but you should have exposure if you haven't. Global property has a propensity to outperform global equities under most conditions, and there's currently a substantial pricing disparity. The debate then is not whether you should or should not include the asset class in your portfolio, but rather what is your percentage allocation. The obvious source of diversification into global property is cash, and Norio Rubini addressed it quite succinctly. If you're holding cash or near cash, you are losing significantly. However, there is another not so obvious source, and particularly now, is that you should be diversifying out of general equities into a portion or an allocation out of general equities into global property. Thank you.
Thank you, Greg. Very insightful presentation indeed. You actually answered a couple of questions that I do have. Maybe just a very quick question from the audience. I just want to confirm quickly, Anil, you've also showed some numbers on your forecast on global REITs. Just want to confirm those numbers, they were in dollars, right?
Sorry, myself?
Yes, it was the forecast numbers you showed was in USD, right?
USD total return, yeah.
Good. I've only got one question, and Greg, it speaks a lot to what you presented on, and it goes to that allocation. You know, if I construct a portfolio, whether the allocation to global is 10 or 15 or 60%, doesn't matter what that percentage is, I'm a firm believer that global property is a very good diversifier. I fully agree with you. I support that as well. I think the audience also realize that, but if I look at returns over the past year, global equity, and this is from a South African investor perspective, so in ZAR terms, global general equity just about 10.7 as at the end of March over 12 months. Global property just short of, in general, just short of -8. So it's a very difficult argument if I look at historic numbers to say, you know, but what percentage do I up my global exposure, global property exposure? What do I take away from equity general or global equity? And like I said, Greg, you've addressed most of that, but if I can maybe just get the perspective from both you and Anil, and Greg, maybe you can go first. What makes the coming cycle or the next 12 months to 24 months different to the past 12 months? And why would I up my global property exposure? Is it because of simply just super cheap valuations, or are we in a cycle where we're really going to see some great growth or good returns relative to global equity? Greg, if you want to go first.
Eugene, I can just support what Neil has pointed out. In our portfolio, we are seeing 10% compound growth in US dollars in earnings in our portfolio. And we can ignore sectors like general office 100% and yet have a significant diversification because there's so many sectors and subsectors. And let's just see, even it differentiates it from country to country. For instance, self-storage in the UK is not necessarily and always correlated to the US and Australia. So we have plenty of choice to get the diversification that we're looking at. And those extraordinary figures, I must emphasize, extraordinary 10% compound growth, and we see 10% compound growth in our portfolio with the dividends actually increasing, as Neil touched on it. They'll be distributing more than the actual earnings because they've been quite conservative to date. So let's get to allocation. I just want to say the three most important things into performance is allocation. The second most important is allocation. And Neil, maybe you can remind me on what the third most important. Yes, I know what you're saying. It's allocation. So of course, if you get your allocation right, that is what your performance is. I want to give you an extreme example, and this is my personal. I have got a retirement annuity. I'm allowed 45% offshore. And of that, of course, global property can only come out of that 45%. In my retirement annuity, I personally have 25% exposure to global property and only 20% offshore. To global equities.
Global equity.
It is an extreme example. I'm there, I'm close to it. Just trying to say, even in Regulation 28 environment, and you should be having at least 10%, if not more. And what belies is that here I'm going to make a projection. I believe between now, Q2 and Q3, a pause or a slowdown or a stop is coming from interest rate rises. And there we saw in January alone, we saw REITs recover in US dollars by 9%, 9 to 10%. Don't miss out on that allocation, notwithstanding you're going to have strong dividend growth.
Thanks, Greg. And Neil, anything you want to add to that?
Just going towards your question, I would say stick to the fundamentals right now. So because of the various sectors to choose from, you can choose a sector or sectors where the fundamentals remain very, very strong. That strong fundamentals will lead to inflation beating cash flow growth. You match that up with solid balance sheets, and then you're going to get fundamentals at a reasonable price, and you will expect to outperform with that strategy.
Fantastic. Gentlemen, I think you've hit the nail on the head. And again, I still stick to my guns. Global property, a very good diversifier. You make your case for that as well. To our audience out there, thank you so much for joining us this morning. Quick reminder, next week, Wednesday, we're looking at global and local credit with Fairtree. So joining us for that session, also very interesting and topical at the moment. To Anil, I know your teammate Naeem had to run for another meeting. But to you and Naeem, thank you so much for joining us this morning. Very insightful. Greg, a really good presentation. Thank you for that. To our audience, if you need more information or you want to speak to either party, Sesfikile or Reitway, please let us know. We'll get you in contact with them. They're always very happy to engage with you. And if you have more questions on local or SA property or global property, please let us know and we'll get you in touch. And until we see you again next week, Wednesday, to the BCI team, to our presenters today, you've done a stellar job. Thank you so much. We remain grateful. Thank you.
Thanks, guys. Cheers. Bye-bye.
Bye-bye.